What if building wealth wasn't complicated? What if you didn't need stock-picking skills, side hustles, or financial genius to become financially independent? In this book, you'll discover a simple path: save consistently, invest wisely, and let time do the heavy lifting. No shortcuts, no hype, just a strategy that has quietly created freedom for millions. This is not about getting rich fast. It's about getting free. Introduction: Wealth is simpler than you think. The central idea of the simple path to wealth is both powerful and reassuring. Financial independence is not something reserved for financial experts, high-income earners, or people with specialized knowledge. It is not a secret club that only a few can enter. Instead, wealth is built through simple behaviors: saving regularly, investing consistently, and making thoughtful financial decisions repeated patiently over many years. The book challenges one of the most common myths about money: that building wealth must be complicated. Many people believe they need to pick the perfect stocks, predict market movements, or understand advanced financial strategies to succeed. J.L. Collins argues the opposite. He shows that clarity, patience, and discipline outperform complexity almost every time. The people who succeed financially are rarely the smartest in the room. They are the most consistent. Rather than chasing money endlessly, the book reframes the purpose of wealth. Money is not the finish line. It is a tool that creates security during uncertainty, reduces stress in everyday life, and most importantly, provides control over how you spend your time. True wealth is the ability to make choices where you work, how you live, and what you prioritize without constant financial pressure. This shift in perspective is what makes the message so transformative. When money stops being about status and starts being about freedom, financial decisions become simpler. Spending becomes more intentional. Saving gains meaning. Investing becomes an act of building your future rather than chasing quick wins. At its heart, the book revolves around a single question, one that resonates with almost everyone. How can ordinary people build extraordinary financial freedom? The answer is surprisingly simple. By focusing on habits instead of hacks, consistency instead of perfection, and long-term thinking instead of short-term excitement. Over time, these small, steady actions compound into something remarkable: a life where money supports your choices instead of controlling them. The wealth mindset: freedom over status wealth, does not begin with numbers, investments, or salaries. It begins with mindset. Many people assume that earning more automatically leads to becoming wealthy. But the simple path to wealth challenges this belief. The book argues that perspective matters far more than income. Without the right way of thinking, even a high salary can disappear into spending, while a modest income, guided by intention, can build lasting security. In modern society, spending is often used as a signal of success. Bigger homes, newer cars, designer brands, these become symbols people use to prove they are doing well. Yet this constant signaling quietly delays freedom. Every dollar spent to impress others is a dollar that cannot work toward independence. The real turning point happens when a person shifts from consumer thinking to owner thinking, from asking, "What can I buy?" to asking, "What can this money become?" At the heart of this shift is a powerful realization. Money is a tool, not a scoreboard. It does not measure your worth, your intelligence, or your success as a person. Its real value lies in what it allows you to do. When individuals begin to see money as something that buys time, flexibility, and options, their behavior naturally changes. They become less focused on appearances and more focused on building a life that feels secure and intentional. This mindset favors long-term security over short-term gratification. Instead of chasing immediate pleasure, it prioritizes stability, growth, and freedom. Over time, these priorities reshape daily decisions: how you spend, what you save, and how you invest. True wealth, then, is not defined by luxury, but by autonomy. It is reflected in simple but powerful abilities: the ability to walk away from situations that no longer serve you, reduced stress about everyday expenses and unexpected events, greater control over how you spend your time, the freedom to choose the kind of work and life you want. Without this mindset, even the best financial strategies struggle to work. Knowledge alone is not enough. Behavior ultimately determines outcomes. When mindset is aligned with long-term freedom, strategies become easier to follow, and consistency becomes natural. That is why the journey to wealth always starts internally with how you think about money, before how you manage it. Debt. The biggest barrier to freedom. Debt is often invisible at first. It doesn't announce itself loudly. Instead, it quietly restricts the choices you will be able to make tomorrow. The book describes debt as a silent constraint, something that steals flexibility from your future before you even realize it. Not all debt can be avoided. Mortgages, education, or strategic business investments may serve a purpose. But high-interest consumer debt, credit cards, impulsive financing, lifestyle purchases carries a different weight. It works against you. While compound interest is one of the greatest forces for building wealth, in debt, it becomes a force that slowly erodes progress. Your effort remains the same, but the results shrink because interest consumes what you create. This creates a frustrating cycle. You work harder, yet feel stuck. Payments replace progress. Momentum disappears. The message is clear. Avoid high-interest debt whenever possible. If debt already exists, prioritize eliminating it before chasing complex investments. And most importantly, recognize lifestyle inflation, the quiet tendency to spend more as income rises, as one of the biggest hidden dangers. Debt often creates the illusion of prosperity. New purchases signal success externally, while internally they delay stability. True wealth is not defined by what you can afford today, but by how much freedom you preserve for tomorrow. Financial independence cannot exist while future income is already promised to past decisions. Becoming debt-free, therefore, represents more than numbers on a statement. It is psychological freedom. It reduces stress, increases optionality, and restores a sense of control over time, the most valuable asset anyone has. Spending less than you earn, the core principle. At the center of every wealth-building strategy lies a simple truth. Your savings rate matters more than your income. Earning more can help, but keeping more is what changes outcomes. When you live below your means, you create a gap, a surplus between what comes in and what goes out. That surplus becomes opportunity. It becomes investment capital. It becomes security during uncertainty. And over long periods, it becomes freedom. The book reframes frugality in a powerful way. Frugality is not deprivation. It is intentionality. It is choosing what truly adds value and quietly ignoring what does not. It means spending with purpose rather than reacting to impulse, trends, or comparison. Wealth is rarely built through dramatic actions. Instead, it grows through small, repeated choices. Cooking at home more often. Resisting unnecessary upgrades. Reviewing subscriptions. Delaying purchases. And asking one simple question: does this expense move my life forward or just satisfy the moment? These small decisions compound just like money does. Over years, they create enormous impact. The difference between income and spending is not just a number. It represents time not traded, stress avoided, risks you can take, and opportunities you can pursue. That gap is future freedom in its earliest form. FU Money. The first level of freedom here is an expanded audiobook-style narration version. FU Money represents one of the earliest and most powerful stages of financial independence. It is not about luxury, status, or early retirement. It is about breathing room. It is the moment when money stops being a constant source of pressure and starts becoming a source of choice. The term refers to a financial cushion large enough to allow you to walk away from situations that no longer serve you without panic. It means you are no longer forced to tolerate unhealthy work environments, rushed decisions, or opportunities that conflict with your values simply because you need the next paycheck immediately. In practical terms, FU Money usually equals 6 to 12 months of living expenses. This reserve acts as a buffer between you and uncertainty. It transforms emergencies into inconveniences and decisions into deliberate choices rather than reactions. Its benefits extend far beyond numbers. It reduces fear. When basic needs are covered for months ahead, the constant background anxiety about money begins to fade. This clarity improves thinking and emotional stability. It strengthens negotiation power. Whether discussing salary, business terms, or workload, people who are not financially cornered can advocate for themselves more effectively. They can wait. They can say no. And that ability alone changes outcomes. It creates career flexibility. With a cushion in place, exploring new paths becomes possible. Learning a new skill, starting a side project, taking a break, or shifting toward work that is more meaningful rather than immediately profitable. It also encourages healthier boundaries. Financial pressure often leads people to overcommit, overwork, and accept treatment they would otherwise question. A reserve restores the ability to choose respect over urgency. The psychological shift is profound. Individuals with financial buffers behave differently. They become less reactive and more intentional. They tolerate less misalignment, take smarter risks, and operate from confidence instead of desperation. The difference is subtle externally but transformative internally. FU money is therefore not the finish line. It does not represent wealth in its final form. Instead, it marks a turning point, the first moment when time, attention, and energy begin shifting back into your control. It is a milestone that signals momentum, a foundation that supports larger goals, and perhaps most importantly, proof that independence is not a distant dream, but a series of small, achievable stages. The stock market A long-term partner here is the expanded audiobook-style narration version. The book challenges one of the most common fears people have about investing: the belief that the stock market is dangerous, unpredictable, or reserved only for experts. Instead of portraying markets as chaotic places driven by luck, it reframes them as one of the most reliable engines of long-term economic growth. At its core, the stock market is not a collection of numbers flashing on a screen. It is a collection of businesses, real companies producing goods, solving problems, employing people, and expanding over time. When you own stocks, you are not placing a bet. You are becoming a partial owner of that progress. This shift in perspective changes everything. Ownership means participation. As businesses innovate, increase profits, and grow their reach, investors who remain patient benefit alongside them. Wealth creation in markets is therefore not about timing perfect entries or exits, but about aligning yourself with the natural expansion of the economy. Volatility, however, is unavoidable. Prices move. Headlines create fear. Markets rise quickly and sometimes fall sharply. The book emphasizes that these short-term fluctuations are not signs of failure, they are the cost of admission. Temporary uncertainty is the price investors pay for long-term growth. History shows a clear pattern. While markets are unpredictable in the short run, long-term trends consistently move upward. Economies evolve, productivity improves, and businesses adapt. Investors who stay invested capture this trajectory, while those who react emotionally often miss it. The most important shift is moving from speculation to participation. Speculation focuses on predicting what will happen next, guessing which stock will surge, when the market will crash, or how headlines will influence prices. Participation focuses on remaining invested in the broader system of growth, regardless of temporary noise. Success in investing does not require forecasting the future. It does not demand perfect timing or complex strategies. Instead, it relies on consistency, patience, and the willingness to remain present during uncomfortable periods. Over time, the advantage belongs not to the smartest investor, but to the most persistent one, the individual who understands that markets reward endurance more than prediction. In this way, the stock market becomes less about risk and more about partnership, a quiet agreement to grow alongside the world rather than attempt to outguess it. Index funds' simplicity that wins here is the expanded, audiobook-style narration version. One of the book's strongest and most practical arguments centers on index funds. Instead of encouraging investors to chase winning stocks or attempt to outsmart the market, the book presents a simpler idea: own the market itself. Index funds allow investors to buy a small piece of hundreds, sometimes thousands of companies at once. Rather than relying on a single prediction, you participate in the collective growth of entire industries and economies. This approach removes the pressure to constantly choose the right stock and replaces it with steady exposure to long-term progress. At the heart of index investing is diversification. By spreading investments across many businesses, the impact of any single company's failure is reduced. Success no longer depends on being correct about individual outcomes. Instead, it relies on the broader reality that economies tend to grow over time. Cost is another critical advantage. Index funds are designed to track markets, not actively manage them. Because of this, their fees are significantly lower than most traditional investment funds. This difference may appear small fractions of a percent, but over decades, it becomes enormous. Fees quietly compound, just like returns do. Every percentage paid in expenses is a percentage that no longer participates in growth. Over long periods, even modest fees can reduce final wealth by substantial amounts. The book emphasizes that minimizing friction is one of the most powerful ways to maximize results. Research consistently shows that most professional investors struggle to outperform the market after fees are considered. This reality challenges the assumption that complexity leads to better performance. In many cases, the opposite is true. Passive investing, simple, consistent, and low cost, often produces stronger outcomes than strategies built on constant activity. Simplicity also provides psychological benefits. Fewer decisions mean fewer opportunities for emotional mistakes. Investors are less likely to panic during downturns, chase trends during peaks, or abandon strategies prematurely. A straightforward approach makes discipline easier to maintain. Over time, success in investing is not determined by brilliance, but by behavior. Systems that reduce errors tend to outperform systems that require constant judgment. Index funds create a structure where patience becomes the primary advantage. In this way, simplicity is not a limitation. It is a strategy. A quiet recognition that long-term participation, low costs, and reduced mistakes form one of the most reliable paths to wealth building. Great, this is a core section of your audiobook. Below is a long, expanded narration chapter, deep storytelling style, that flows naturally for voice AI. Financial advisors understanding incentives. Many people assume financial advice is neutral. The book challenges that assumption. It encourages readers to understand a simple reality. Incentives shape recommendations. Not all financial advisors operate the same way. Some are fiduciaries, legally required to act in a client's best interest. Others are compensated through commissions, product sales, or activity. This difference matters more than most people realize. When compensation depends on selling specific products, insurance packages, actively managed funds, complex portfolios, complexity often increases. Fees become layered. Activity appears productive, but the long-term impact on wealth can be quietly negative. High fees reduce compounding. Frequent trading increases costs. Complex strategies create confusion that keeps clients dependent rather than empowered. The book does not argue that advisors are unnecessary. Instead, it suggests that blind trust is risky. Education becomes protection. Understanding basic principles allows individuals to ask better questions, recognize conflicts of interest, and avoid unnecessary products. Incentives do not determine character, but they influence behavior. Recognizing this helps individuals shift from passive acceptance to informed participation in their financial lives. The goal is not to eliminate advice, it is to understand it. The wealth formula: save, invest, wait at. The center of the book lies a formula so simple it almost feels incomplete. Save, invest, wait. Saving creates the first building block: capital. Without a surplus, investing cannot begin. Saving is not about restriction. It is about creating options. Investing turns that capital into a productive asset. Money that once sat idle begins working through businesses, markets, and economic growth. Waiting is where transformation happens. Compounding requires time more than brilliance. Growth is not linear. It accelerates quietly until it becomes visible. Automation supports this process. Removing daily decision-making prevents emotional interruptions. Contributions happen whether markets feel safe or uncertain. Over years, consistency outweighs intensity. Large one-time actions matter less than small repeated ones. Patience, therefore, becomes a skill rather than a personality trait. It is a practice, the ability to remain committed while results are still invisible. Market crashes opportunity and disguise every. Investor eventually encounters downturns. Prices fall. Headlines amplify fear. The instinct to act becomes overwhelming. The book reframes these moments. Market crashes are not abnormalities. They are recurring features of long-term investing. Fear causes many investors to sell at the worst time. Losses become permanent not because markets failed, but because participation ended prematurely. Lower prices, however, benefit long-term investors who continue contributing. Future returns improve when assets are purchased during uncertainty. This perspective requires emotional discipline more than technical knowledge. The ability to remain invested during discomfort separates outcomes. History reinforces this lesson. Every major downturn has been followed by recovery. The timeline varies, but the pattern persists. Consistency during uncertainty becomes one of the most powerful advantages available to ordinary investors. Financial independence redefining. Retirement financial independence changes the definition of retirement. Instead of a distant age, it becomes a condition the moment when investments can support living expenses. Work shifts from necessity to choice. The commonly referenced 4% rule offers a guideline. A portfolio roughly 25 times annual expenses can sustain withdrawals over long periods under historical conditions. Lower expenses accelerate this timeline. High consumption extends it. Independence is therefore influenced more by lifestyle than income alone. Importantly, independence does not require stopping work. It expands options, reducing hours, changing careers, pursuing creative projects, prioritizing health, or spending more time with family. The objective is not inactivity. It is autonomy. The simple path is a lifestyle. The book emphasizes that simplicity is not a temporary strategy. It becomes a long-term philosophy. Living below your means. Avoiding unnecessary debt. Investing consistently in low-cost funds. Ignoring short-term noise. Practicing patience. These principles remain stable, even as markets, technologies, and economic conditions change. Complexity often benefits financial industries because it justifies fees and activity. Simplicity benefits individuals because it reduces friction and mistakes. Over time, wealth emerges as a byproduct of behavior rather than a target pursued through constant adjustment. The strategy becomes sustainable because it aligns with human limitations rather than fighting them. Psychological lessons, behavior drives, results, technical knowledge matters, but behavior determines outcomes. Delayed gratification allows compounding to operate. Emotional control prevents panic decisions. Consistency maintains momentum. Long-term thinking reduces distraction. Avoiding comparison protects satisfaction. Financial success rarely fails due to lack of intelligence. It fails due to interruptions, abandoning plans, increasing lifestyle costs too quickly, reacting to short-term events. The greatest risks are behavioral, not mathematical. Recognizing this shifts focus from predicting markets to managing oneself. Time, the most valuable asset money, serves a deeper purpose. It buys time. Time enables flexibility, the ability to adjust schedules, explore interests, and recover from setbacks without immediate pressure. It strengthens relationships because presence becomes possible. It supports creativity by removing urgency. It protects health by reducing chronic stress. It enables exploration beyond survival. Financial independence, therefore, becomes less about accumulation and more about allocation, directing time toward what matters. This reframing connects everyday spending decisions to long-term life design. Common mistakes to avoid. The book repeatedly highlights avoidable errors. Chasing trends introduces timing risk. Attempting to predict markets increases stress and inconsistency. High fees reduce compounding. Complexity creates confusion. Lifestyle inflation slows progress. Panic selling converts temporary declines into permanent losses. Avoiding these mistakes often produces better outcomes than seeking perfect opportunities. Success becomes defensive, protecting a simple strategy rather than constantly replacing it. Who the simple path works for. A central strength of the strategy is universality. It does not depend on privileged access, specialized knowledge, or perfect timing. High earners benefit through scale, larger contributions, accelerate compounding. Moderate earners benefit through discipline, consistent habits, produce meaningful growth. Behavior becomes the equalizer. The gap between outcomes narrows when consistency replaces complexity. This accessibility explains why the simple path resonates across different life stages and income levels. Long-term impact, quiet transformation, wealth building feels slow at the beginning. Contributions appear small. Growth seems minimal. Progress is easy to underestimate. Compounding delays visibility. The most dramatic changes occur later, not earlier. This delay causes many individuals to quit prematurely, believing the strategy is ineffective. Understanding the timeline prevents discouragement. Transformation happens quietly. Years of consistency eventually produce acceleration that appears sudden from the outside but is gradual internally. Patience bridges this invisible phase. Final message: wealth is freedom. The book concludes by redefining wealth. It is not primarily about luxury or consumption. It is about freedom. Freedom from constant financial anxiety. Freedom to make decisions aligned with values. Freedom to navigate uncertainty without panic. Freedom to design life intentionally. The simple path produces reduced stress, greater choice, and long-term security. It lacks excitement. It does not promise shortcuts. But it offers reliability, something increasingly rare in a world focused on speed. In choosing simplicity, individuals choose sustainability. In choosing patience, they choose probability. And in choosing consistency, they choose a path where wealth emerges naturally rather than being endlessly pursued.